Welcome back to another weekly review. So, we'll quickly go through the broader market data, some sectors and themes, and finally, some stock structures. So, nothing I say in this video should be taken as investment or trading advice. Please contact your registered investment advisor and then invest according to what he decides is best for you. So, first, we'll cover up the broader market. So, this particular week was actually a very interesting week for the market starting from Monday. It was a strong start. The market opened on a firm note. There were a lot of sector participation. The breadth improvement was seen, something that I've been covering in my last 2-3 week episodes, that the breadth in the market overall is strengthening. It is not great per se, but it is a steady improvement. Broad participation was seen. A lot of sectors and themes were also chipping in, led by, of course, Nifty Bank, and some bit of momentum that is coming back to the market that was actually carried forward. So apart from the 8th session, July 8th session, I'll come to that in a bit, the breadth is now actually in an expansion mode where more and more sectors and industries are joining in and helping the market move higher. Again, where is the strength when it comes to broader market? It is mid cap 100, small cap 100, micro cap 250, mid cap 50, small cap 50, mid cap select. These are extremely strong pockets in the market. And let's say you like a sector XYZ or industry XYZ, try and pick names from this basket for those sectors. You will see those stocks will do relatively well when it comes to overall market. Now, July 8th is when we took a breadth hit in the market. What is breadth hit? So again, some statements came out with President Trump. Probably he was trying to get some of his friends some good trades in the Asian market. God knows about it, but this is a theme we have seen play out again and again. The breadth damage in this particular session was significant. Heading into 8 July, on 7 July, we had about 62% stocks that were above 50 DMA, about 58% stocks above 200 DMA. So this is what is called strengthening and broadening of the market. On 8 July, I think around 1:32 p.m., we just started seeing massive sell-off happening in the market. And the breadth damage was substantial that day. It was 12% with respect to 50 DMA and about 9% with respect to 200 DMA. That is, more than 9% stocks went below 200 DMA, and more than 12% stocks in the broader market went below 50 DMA. Now, 12% won't be a big number for a lot of you, but generally, whenever the market starts to see a lot of reversal, this breadth change is in double digits. So if on that day you cut out your losers, you did some risk management kind of prudence on your portfolio, that was the right move, because you never know next day what happens. President Trump is so volatile, and I've repeated this many times, that a volatile president will always lead to volatile markets. So by July 9th, that is by Thursday itself, we normalized. It was not that the closing was too strong, but the recovery was from leaders. It was from the mid cap basket, small cap basket, some bit of capital markets, some bit of defense, some bit of pharma healthcare, banks. These are the leaders currently. Real estate, that is Realty. I had spoken about it a couple of weeks back, also last week also. So some bit of normalization definitely happened. In hindsight, you can say that was a dip. On that day, if you took some measures to protect losses, that was the right move. Always aim to protect your downside. Upside eventually takes care of itself. So the breadth actually returned to expansion mode on Thursday. On Wednesday, it was a genuine scare. Now, where does the breadth stand right now? 65% stocks as of Friday's closing are above 50 DMA. 58% again back to the pre-July 8th session above 200 DMA. This is overall a healthy trend. So roughly 2/3 of the total market universe has about 750 stocks, is above 50 DMA, and nearly 60% is above 200 DMA. Now, for a market that is broadly sideways, that is genuinely a healthy footing. Now, this is something that is important for you to understand. We are not in a broader market bull run. What is a broader market bull run? When majority of stocks are in stage 2 structures, that is higher high, higher low, superb relative strength. We are not in that kind of market. This is something every week we are seeing through data, that this is a highly theme sector specific stocks pickers market. It is not an overall bull run in the market, because if you look at the Nifty 500 chart, and if you can just pull out on your own laptop or mobile device, you'll find that Nifty 500 is in a range, this kind of a range. So it's in a 15% kind of a contraction range that is going on Nifty 500. We are still digesting the gains of 2021 to 2024. So as I said earlier, this is a sector and stock specific bull market. Nifty 500 is in a range of 15%. It is likely to move like that, in my opinion. We'll be in a sector and theme specific bull market, but I don't think a broader market bull market, a one-sided kind of bull market that is, let's say, playing out in Nasdaq or S&P 500, that is going to happen in India so soon. No, it won't. I think maybe next year, 2027, you can hope for it. And I say hope because these days things change so soon in markets. So what is happening is money keeps rotating within stronger pockets, some new themes set up. So the broader market picture tells you that breadth is expanding. July 8 dip was noise because see, if you're someone who's into BTST and futures and options, then sessions like July 8th will impact you. But if you're someone who's into a little medium term kind of position taking, whether it is into stocks or any other instrument of your choice, then July 8th would be a session where you would have managed some position, cut some losses off, basically risk management kind of a day. Otherwise, it shouldn't bother you. The sessions like July 8th, always remember, are sessions where you should not do anything impulsive. That is, don't sell off your winners, don't buy anything, don't buy a falling knife, that kind of thing. You just have to breathe, be calm, and analyze market on end of day basis. As it is, we are currently in a market where it is better if you don't track it during the day and track it only in the evening when end of day data publishes. You'll do much better. Again, unless and of course you are into this BTSD and option writing, selling, that is then a completely different game. And such sessions obviously will make people lose a lot of money. So this I've repeated: 65% above 50 DMA, 5800% above 200 DMA, and still remains a stock pickers market. The next is we will see what is happening on the individual sector front. So within sectors and industry, you're still seeing the strong leadership persisting in the market, which is financials, it is private banks, capital market, housing finance in particular. There is an index called Nifty Housing Finance also. Look at that index. Decent structure of that index. Now, bank-led recovery, this is a point I highlighted a couple of weeks back, that once bank starts improving, a lot of peripheral sectors fall into place. Realty, auto components, core housing, eventually infrastructure also will start moving. That is the impact that banks has on the market. Within healthcare, you are seeing pharma, healthcare, and mid and small cap healthcare. Anything that you're interested in, look into mid and small cap space. Again, there is a dedicated index that is called Nifty Hospital Index. There's an ETF also, I think, hospital ETF. That ETF also, again, part of a larger healthcare basket. Exceptional strength. And then there are some momentum themes like defense and new age consumption defense has been the leader since the correction was going on early part of the year. New age consumption had alerted about, along with realty, that this is one theme that is setting up. And you can definitely see this. So again, it all starts with Nifty Bank. What I'm seeing is that first the trigger was improvement in Nifty Bank, mainly private banks, and then realty, auto components, auto housing, core housing, and even the consumption part of our economy have started doing very well. Infrastructure is in line. This is definitely on my watch list. Sometimes what happens is you tend to go behind names that are already in the news. So today Nifty real estate has moved 15 odd percent in 2 weeks, so it'll be making a lot of headlines. That is not when risk reward is in your favor. Always keep in mind what can move next. Ratio charts are excellent. What is ratio chart? Nifty infrastructure divided by Nifty 500. See if it is rising or coming out of a base. That is usually a telltale sign. Now, the quiet themes are worth tracking. This is a dedicated slide. So IPO space has already been buzzing. Again, if you're watching my video since February, March also, this is one space I've repeated again and again. Low ownership, less float. These stocks generally tend to do well when the market bottoms out. There is a pocket called Nifty India Internet. There are ETFs, dedicated ETFs also for this. Again, nothing I speak is investment or trading advice. This index is also getting into a great structure, along with tourism, transport, and logistics. Again, if you see, this is the consumption part of the economy, not the IPO part. I mean, if you want to justify whether IPO comes into consumption, I can make a case for it, but that would be a little bit far-fetched. But tourism, transport, logistics, India, internet, and consumption, new age consumption. This is directly about consumption. And the consensus, again, I mentioned this in the last week's video also, that economy is not weak, so consumption cannot pick up. But something is changing on the chart. And it is always the data that is more important than whatever you hear on social media, because opinions are always clouded, because there are so many people who just cannot separate data from whatever they think is right or wrong in their own world. So in my view, the consumption basket, whether it is tourism, transport, logistics, India, internet, something is happening in that pocket. You just look at ratio charts, they are turning, and it is possible that in the coming few months we will start seeing better economic data. Now, what's not working today? CPSC, PSC, Nifty Power, PSU Bank, Nifty IT, Nifty Metal, Commodities, FMCG, Nifty Cement. I'm still not convinced about FMCG. FMCG, I think, needs to improve its structure further. But in this pocket, you have to be careful in not labeling Nifty Metal, PSU Bank, and Power as a laggard or a weak sector. Because these three pockets were actually leaders in the March-April cycle. And because they run up so much, now these pockets are not doing well. That is why they come in the not working kind of group. Couple of months down the line, maybe capital market and defense will be here, because those sectors will also digest the gains that have taken place in the last quarter. All right. So weakness is not broken. This is what I've written, which is for three pockets: Nifty Metal, Nifty PSU Bank, and Nifty Power. So this is where a dip is coming or happening or taken place on a weekly time frame. Now these sectors are again consolidating, and they'll probably set up again. So these have shaken out a lot of people, but definitely the long-term structures of this particular pocket are beautiful. Look into this. Nifty Chemical has a lot of potential, because a lot of I was seeing while going through stocks, a lot of chemical stocks were actually forming beautiful VCP contractions, and very close to 50 DMA bases, and were breaking out with fantastic relative strength. Again, the market regulator and NSE, BSE have made it so easy for you. You now have a dedicated Nifty Chemical index that you can track from nseindia.com or niftyindices.com. So just a snapshot: Realty, Pharma, Defense, Capital Market, Private Bank, Auto, Housing, Finance, Healthcare, and Consumption. These are the pockets that are strong and are doing well today. These are sectors that are consolidating, which is Metal, PSU Bank, Power, Chemical, Infrastructure, India, Internet, and IPO space. All these pockets were leader, because earlier Realty was not there, private banks was not there, auto was not there, housing finance was not there, and consumption was not there. These were here, and all these were here. So now rotation has happened. So when I had alerted about realty or banks or capital market or defense, everything was consolidating back then. So that is when you have to start looking. So today, start looking here. Which pockets are consolidating within a larger uptrend? And can you find some opportunity there? I'll open up a couple of structures also, without name, of course. I cannot put out any kind of chart that highlights a particular stock. What is clearly lagging is IT, FMCG, cement, commodities, CPS, CPSC. IT is a play only for those people who can invest for 4 or 5 years and forget. Because I don't think anybody can tell you where Nifty IT is heading. See, once something gets weak, it keeps getting weaker unless and until there is a massive catalyst. IT is lacking that catalyst. It's not their business is going away. Recently, TCS came out with numbers. Business is fine, but there is no massive catalyst. All right, that is why this sector will continue to struggle. And in terms of valuation that you're hearing, valuation is cheap. Valuation is fair, I would tell you. It has still not reached the global financial crisis lows or the COVID lows also. So valuation is very fair, if I have to put it. It is cheap, but it is not in that territory where you can make a blind bet on a sector that is continuing to fall. Of course, these stocks are so cheap now. And of course, those fund managers who are asking you to buy this in 23, 24, when these heavyweights were double from where they are, should come out and justify what were those buy calls about, and why suddenly now they are so against IT, criticizing management, and now they want to buy Nasdaq stocks. So essentially, you have to understand that everybody is a momentum chaser. They want to disguise themselves as a great value investor or a great fundamental analyst, but they are actually a momentum chaser. Who are I don't know. They are shy to accept that they are chasing momentum. Else, you won't find so many talking points about investors now heading to US to invest their money. Now is late. AI theme, probably it's not over, obviously, but it will be volatile. It is not that smooth market anymore. People were getting excited that now our brokers will give you direct access to US market. Why now? Why not 2 years back? You have to think about these things. Is it entirely possible that suddenly all over the world now it is being allowed that you can start investing money in the US, and millions of people who will put up their small token of money, are they going to be the ones who are going to give exit to a lot of people in that market? It works both ways, because if this theory is going around that we guys, the retail people of India, are giving FIIs exit, then this theory also has to be true, that now suddenly our money can easily move abroad and we'll start buying all these Nasdaq S&P 500 stocks. And are we going to provide exit to certain people? You got to think about all these things. Some news point should not be celebrated. That is my view, and I can be completely wrong. So currently the rotation is banking sector led. Sweet spot remains the small mid micro cap space. The quieter themes that were strong earlier have now consolidated. Look into these. And especially for metal, PSU bank, power, current weakness does not mean the overall trend is broken. Now, before I end the video, I'll open up 3 stock structures for you. Obviously, no name. I cannot take name, but currently there are 3 type of structures in the market. First is this kind of structure. That is 40-45% above 50-day moving average. massively outperform the market, suddenly making a lot of buzz on social media, on news channels. When you find such structures, stay away. Stay away because one candle of 10, 20, 30% could cause massive damage to your open positions. Never go behind themes where there is a lot of hype. The next structure is this kind of structure, a stock that has run up a lot but is again coming back to 50 DMA. Something very similar to this, run up a lot, coming very close to 50 DMA and consolidating. So these are the structures that should be on your watch list. So first structure, avoid. Second structure, watch list. And then there is this third structure that has already done all the hard work for you. It has rallied a lot, come back to 50 DMA, consolidated, and then broken out. So this is the immediate buy structure. I would still not want it 10% above 50 DMA. I would like to catch it within 3, 4, 5% of 50 DMA. Let's say a couple of more candles. That would be fantastic. But this is the structure you have to act on immediately. This, keep it on your watch list. This, avoid. So these are the three pockets that are available in the market currently. And yes, then there are some many structures that are deeply below 50 DMA, 200 DMA. You just don't have to look at those also. That's a complete waste of time. But anything that you do in the market today, any pocket or any stock that you want to buy it in the mid cap, small cap, micro cap basket. For large caps, I will tell you, and again, this is not an investment advice, but for large caps, broader themes, it is always better to be in ETFs. You don't have the headache of individual stocks. To get more alpha, obviously, small, mid, micro cap space is ideal for smaller investors. All right. So I'll see you next week. Thanks a lot for watching, especially for those of you who tune up every week. Thank you again. Take care and be safe.